All right. Good morning, everybody. We got PPI today. So again, another chance for a liquidity gap. PPI generally is not as volatile as CPI. Markets continued that late afternoon push, spread out around the world. Hong Kong is basically flat. Japan also, and then the Russell around 0.25%, S&P above 0.25%, and the NASDAQ very close to 0.5%. We're going to get a little bit of jobs data today. Friday, we get more, but the big deal is still OPEX. It's still the hurry up and wait. So we can see the impact. These change color based on volatility and the history of the product. So producer price indexes, PPI has a history of causing some volatility. They got it listed out pretty dark. We've got some additional auctions today. And we're going to get a little data out of Japan, but really with Japan, the whole issue is them raising rates and coming out of that negative interest rate environment. It's still just a whisper right now, but it's kind of a big deal. We're going to get a lot of Fed speak out of Europe through the day today. You can see European central bank speakers through most of the day. So this was a little interesting on the Netflix and Meta benefiting from ByteDance TikTok ban. Even though the ban isn't in place yet, hasn't passed, just the discussion of it. And of course, they caught Trump saying something negative about Facebook, how that ties in with his own little social media, that VWAP or whatever. Maybe someone will end up throwing shade on that, right? That kind of a little bit of a conflict of interest, but they didn't mention that social media platform, mostly just pushed the idea that these others, Facebook, Netflix, are going to benefit from that. TikTok. We'll see. It's still a lot of hurry up and wait, really, is what it comes down to. So really light trading volume, sitting in the 70s like we were on Tuesday. We didn't keep our missed daily pivot. We tagged it late yesterday afternoon. And so far, we have an MDP, just barely, but barely does count. We have an MDP this morning, a missed daily pivot. We did make it through that green line finally. That's a voodoo line that I believe is called Forest. I've had people ask about the lines and the levels on my chart. If I have an indicator that I have made or that I have found and that I can give away without violating terms of service, I give it away. I have no qualms about that. But there are some indicators like this voodoo line that I can't give away. It's not mine. I didn't make it. And they've made it really clear that if they catch you giving it away, they're going to come after you. And I don't want them coming after me. So you would have to go get it from the source, and that would be simpler trading voodoo lines. They are hand developed, by the way. I can tell you that if you go in and look at the code, and I code thinkorswim indicators, there's no formula in there that's deriving these lines. They are hand drawn lines, and those levels are placed in there. And every couple of weeks, month or so, you have to keep going back to the website and getting an updated version. So I can't replicate it, right? Because I don't know everything that they're using to derive those lines. I've watched a few videos on them, and they have some Elliott wave in there, and I don't do Elliott wave, not even a little bit. So I couldn't recreate those lines even if I wanted to, but that's not even all of what's in it. So, you know, I can't reproduce that. But everything else outside of those voodoo lines that is on my chart is shared in the YouTube description. I just went in and took every single chart that we show every day, every single day, and I put them in the description of the YouTube video. So if you want them, just go watch the video, open up the description, and you've got them all. So we kept our breakout so far on the week. It's really going to matter at the close of tomorrow, right? So weekly candle, it's still in flux, but we had a nice pause last week and then a continuation this week. And so far, we're still holding and pushing towards the highs. That's a nice close. But any close that is better than the close that we had last week is going to be considered a positive close, even if we fade all the way back down and get below that 5150 level. Spot Gamma has been calling 5150, but on the SPX, not the ES, right? So flip over. When we look at that 5150, it's not very far away, right? We closed at 5165, and we're looking at 5150 as the pin point on Friday. Pinning is not necessarily so popular nowadays, but with OPEX, there's some times where there's just overwhelming amount of optionality at a particular point. And right now, everything is pointing to 5150. I tried to get a butterfly there for 2 days. And since I'm not willing to pay up and I keep trying to fill, you know, at the current asking price and or around that without bumping it up, I can't get filled. So if you're willing to pay 20, 30 cents for that butterfly, then you can probably fill. On Tuesday, I was trying to do it with calls because we were still under the line. Yesterday, I was trying to do it with puts because we were above the line, and I couldn't get filled on either one. But I wasn't willing to pay up. I think the most I offered was 15 cents. And throughout the day, I seen it as low as 10 cents both days, and I still couldn't fill. So the thing is, by law, they have to take your trade if they deem that it is, quote, fair market value, right? And that's how they get out of not taking your trade when they don't want it. So if you keep pushing the price, then at some point they will fill you. The problem is the SPX is a nickel-based option. It's not penny-based. So every incremental change is another nickel. It's another $5 and another $5 and another $5. And they'll just argue if you try to fill it 10 cents, oh, you weren't offering fair value. Same with 15. So maybe you'll fill around 20, 25 cents, but I'm thinking probably 30 cents is when you trigger it and finally get it in there. It's worth 30 cents, but you don't want to pay up on just a lottery play, right? There's no play here other than an optionality level, 5150. No statistical edge to that either. So I don't want to pay up for a lottery ticket. So we're above the forest or the voodoo line that's green. We're still inside this pivot point from last week. I know it doesn't show that on the weekly here, But this is the confusion and the craziness of swapping contracts, right? So if we go in here, show, that's already set. Let's try this side. Yeah, that's just the way it is. I see a pivot point here. We're underneath it. It's last Friday's levels. It's what we need to focus on. Even if out here, it's still got us as an inside week breakout. Don't let it stress your head, right? Within a day or two, into the new week, so probably Monday or Tuesday, a lot of this will be cleaned up. The brokers will just go in there and get it adjusted, and it won't be off like this. You want to see that, you can go back to previous contract changes and see that we had the same situation, and the same situation was resolved, if you're even able to see it now, right? Because like I said, they go in and they make changes. All right, so the put wall has been rolled up. Call wall still at 52.61. There's quite a number of overlap levels higher than the call wall. And the volatility trigger and zero gamma are basically on top of each other. I mean, they're close enough, they might as well be. We're closer to the higher end of the ADR than we are the lower end. So it makes sense that we hit that 52.61. If we hit it early enough, we can go to the other side, 52.11, which is a cog line, by the way. But to get there, we'd have to get back below the voodoo line, break through our pivot point, and then move to the downside. A couple of other voodoo lines and ancillary levels from spot gamma before we finally get to the ADR on the other end. That would give us a quick move back towards that 10-day moving average. It would also get us back inside yesterday's range, since we're inside day breakout. Since we're out here on the daily anyways, 52.56 is the line that we want to keep our eye on. That's this level back here from Friday. So with the possibility of a liquidity gap, we've got the possibility today for a really big move in one direction or another. Now we've already got hedging, but there's still the issue of the hedging flag or that market maker move showing up because of the roll. Every time we get a roll, we end up with a week where we see that market maker move symbol a lot. And then we come in and we look in the options chain, and it's not supposed to be there, right? Like this morning. So we've got these 0-day options here. My drawing tool isn't drawing. Twitter. That's what happens with multiple screens. All right, whatever. Let's try again. There was a little bit, some lightning. You made a good call yesterday, by the way. That was around noon when you said that. And the alert or the warning came in probably at 5:30, 6 o'clock. So you want to look at the front end options and the next options expiration out. Now there's an AM settled. And right now that market maker move very likely is skipping this one and is actually looking at the AM settled one, which is 1039 versus 1048. The difference between those two is where we're getting our market maker move. So it's the AM settled one that's throwing us off and giving us that market maker move. It's not just because of the contract roll. So there is a little bit of hedging if they're hedging these 0-day options enough to get that number up. And now we're up to 10.5 versus 10.39. So that's the number you're going to want to watch, is this front one, the 0-day. Forget the minus one. That'll come off as we get into the open. And if this number continues to rise, then it continues to show that they're hedging even after PPI this morning, which we're going to get at 8:30. Ten-day, 30-minute volume profile. We're back against this top. We talked multiple times this week about the fact that this profile isn't going to change with the point of control here and where 70% of all the volume is located. We're not going to see a change in this profile anytime soon, unless or until we break out. For one thing, the longer we stayed in this zone, the more volume we were just going to build up in this zone. But the other reason is this is where the bulk of all that volume started. Of course, I don't have my darn drawing tool. So until we get past Friday and into the new week to see these levels get taken out, and that's where all the volume is, we either have to build volume up in a new location or we have to leave this zone completely for anything in this profile to change. Now here we've got a discrepancy. This is a 5-minute chart on the ES. We have the possibility for a VPOC, which we can get to in a second, but the point of control for the volume profile is where we're at now, 5250-ish, close enough. And we can see there's a lot of volume here, that we spent a lot of time here by volume, but not as much as down here. So this is showing us that we spent, a considerable amount of time down here, but look at the volume compared to up here. When this point of control gets up here, then we'll be back in sync again between the two. At this level, it's not really that important. What we would have wanted to see was back here when we first got into this area, because if we came into a large liquidity pool, big order sitting up there like a ceiling, then we could have seen a point of control show up, and yet we'd have had a very minor amount of time, because if we just got there, it would look a lot like this section. It'd be very shallow. So now we've been here long enough, we built this level out. It doesn't really represent all that much, other than the point of control hasn't moved. Now we could go back using Thinkorswim's monkey bars, or a regular TPO chart, footprint chart, things like that. We could go back and evaluate all of that if we needed to. And we don't need to. We're not going to. We don't need it. We're not going to get anything out of it at this point. So the VPOC, there's an argument to be made that we've already hit it, and therefore we don't need to mark it. Now, there's no wrong way to do this, but however you do it, you want to be consistent in it. So don't make a decision one way this time and a coin toss, make it the next way next time. Try to find consistency in how you apply things like a VPOC line. So we never crossed through and closed below on the other side of the line. There is an argument to be made that that level still has a lot of unfinished business to it, because that's really what we're marking out, right? What's point of control in the first place? It's where the most volume took place. That's it. If you eliminate all of the other fancy language and assumptions, the fact is that's where the most volume traded yesterday. And it's very likely that if we revisit that level in the future, as long as we're not too far in the future, that it's a level that has a lot of interest to a lot of participants. Why? Well, I mean, think about if you had got in there yesterday, long or short, and you're still in it now, and we're back where you started. How are you going to feel about your trade? You're going to have interest in it. That's it. It's that simple. So this is a level that you have to decide, does it still have interest? If you're following the rules and the rules say we draw the line and we keep the line until it gets hit, well, then we've got hit. So you're good. You don't have to draw it anymore. But if you're drawing that line because it actually has value to you as a level of unfinished business, and that technically we might have tickled that zone, but we really haven't crossed through there, then it might still have some unfinished business that's worth marking out. Kind of goes beyond the letter of the law into the reason for the law, I suppose. Right? There's always some engineer who wants, some perfect little checklist sheet that has it all laid out nice and easy without going through the thought process of why are we even marking this line in the first place. I know we pick on engineers. I'm one too, so don't feel bad. Although technically I'm retired from engineering because I got my degree in 2020 and it's been 24 years. So yeah, I don't need the old jokes, sucker. We're still in the box. So 52.62 is the upper edge of the box. We can wick out and come back in again. Remember, we expect to close inside the box 80% of the time. So we can leave the box, but we still have that expectation of it coming back in. The history shows that we have about an 80% success rate. But the shortcut way of getting to that 80%, when I do the math, I just count back 8 weeks. Technically, we need to count, like a whole year or year to date or something like that. But that's a lot of weeks to count. I can just count back 10 weeks. It's easy math. If we close outside at the end of the week, more than 2 out of 10 weeks, then we've broke our 80%. But you will find, though, that we do close out of the box, right? At least a few times. And in the last 10 weeks, we've closed outside of the box more than we should. So it's not the kind of environment to be putting on weekly iron condors and, playing the butterflies on the levels. We're just too violent for that. We keep overshooting the levels. Yesterday, for an example, the 0-day iron condors, I had one on and legged out of it. First the put side and then later on the call side. And sure, I mean, it went well. It's a sideways day. You might as well put on an iron condor. And, it's a sideways week, even though we are continuing that grind to the upside. But for a week-to-week iron, we're still not in that environment yet. And then there's still the argument that the weeks are still too wide. If you weren't trading before COVID got here, you might not quite grasp that concept. But the weeks that we have right now, even this narrow one from last week, it's still a very wide range compared to what we used to have before COVID. And these ranges are derived by volatility. So when people say, but volatility is really, really low. Yeah, the VIX value of volatility may be really low, but the moves in price are not. And volatility is a nerd word for movement. And when you have something that is implied, it is promised. So swap the words around: promised movement, implied volatility. As long as implied volatility is high, the promise of movement is there. And we continue to see really big moves. Even look at the ADR right now. We still have an ADR of 1%. Pre-COVID, the ADR was half of that. Right? And that was in a 24-hour trading period that you might move 25 points for the entire day. And in the RTH session, a lot of times you were getting 12 to 15 points. If you were lucky, if it was a good day, you'd get 15 points from top to bottom. So we're still in a volatile environment. These ranges are still really big. And if you put on an iron condor that covers the entire range, you've made the condor so wide that there's no money in it. You'll get like 10 cents in credit on a SPY, or, maybe $1 on the SPX, maybe, if you're lucky. I think it's stretching that, but it's really low. And then, a lot of strategies say, oh, we'll close your iron condor at 50% profit. So not only did you collect 10 cents, but now you're closing it for 5 cents. So you're risking $95 to make $5. And I guarantee you can win 12 times in a row. Take out one loss and you're right back to where you started. Right? The win rate doesn't match the amount of credit that you're getting at this level. We need the box to constrict more to make the iron condors useful again. So we're not there yet. We're at 4.33%. As you can see from the line that I drew yesterday, we're higher than we were yesterday. And again, it's the same discussion. We can look back and there's not very many times where we've been higher than this outside of the COVID environment, right? Normally we just keep that part tucked away because COVID wrecked a lot of models and a lot of tools. If you get into that time period, everything just kind of gets out of whack. So leave that part off of it. Even out of that first year, I'll leave it where we can see it, but it really started into that new year, 2021, and then 22, 23, and where we are now. It's not very often that we're at this level from the 10-week. So we're overbought on that time frame. We're extended, overbought, take your pick, whatever word you want. Just be aware that the market can stay overbought. It doesn't owe you a pullback just because we've reached that mythical qualification that we can say, oh, it's overbought. It's not immediately going to just turn around and go the other direction. So bearish neutral would make more sense than just straight up being bearish. And for the daily, we're on our way back up again. We're at 0.84% away from the 10-day moving average. We still haven't got a reset yet. And we're still holding within this zone or range that we've been building since the first of the year. It's hard to see, but the blue line is starting to curve up a little bit, which means that our average distance from the 10 is starting to increase a little. It's just another volatility image. But on this time frame, on the daily and below, we're not overbought. We're not overextended. It doesn't owe us a pullback. And it is interesting to note this cyan line, which is an anchored VWAP, anchored to the first of the year, it's starting to flatten out. Now, that could just be the new contracts, right? It could. But it's been climbing steadily until now. So it's worth pointing that out. All right, a lot of analysts in the morning use a benchmark of 0.5%, or of 1%, and I don't. One of the reasons I don't is because I do the morning briefing early enough that if I used 1%, a lot of days there just wouldn't be anything there. That's really the biggest reason that I don't use the 1%. The other reason is 0.5% is a good starting point for things that are not yet already stretched too far. All right, so when I come in here in the morning and I look at this watch list and I sort them by change percent, I want to see what's up and I want to see what's down. And my benchmark is that 0.5%. But if you're doing this on your own, you can use a different metric than I am. I'm using that 0.5% because of the time frame and those constraints. But you can be more selective and start at 1% or even 1.25% if you're doing this right before the open. There's no wrong in this approach. Just use it in a way that suits your needs. For me, it's 0.5%. And if we look at what's up this morning and what's down, Bitcoin is down more than 0.5%. Nat gas and China ADRs. Look at what's up. Semiconductors and really a little bit of uranium. That's not overly exciting, right? The S&P needs consumer discretionary, financials, technology, not uranium. Semiconductors would be good, but this is just like a double, triple leveraged product, and we don't have a lot of the other, say, like where's SMH? If we're going to look at semiconductors, I'd want to see that up here, and we don't yet. Now, all of this can change, of course, after we get data at 8:30. But so far, it looks like a hurry up and wait day. So we're expecting more choppiness. We're going to get European data, which could provide a little bit of volatility through the afternoon. And then we're gonna, go into close and go sideways until tomorrow and get our OPEX. So coming over to TrendSpider, you can see energy's up a little bit this morning. XOP, XLE, and tech is getting there. It's almost at 0.5%. It's not quite there, but it's moving in the right direction. Those China ADRs already pulling back again after that nice rounded reversal yesterday. Cloud computing, it says cloud is down, but it's just one tiny little print. It's not actually, like getting flows and headed to the downside. You got to be careful with this one, because you can see yesterday, for an example, where it had a really low print and then it opened way back up here again. Opened up there and faded down. All right, so don't let this one single print throw you off on cloud computing. That ETF is not very liquid. So even in the Globex, a lot of times it won't even give you a pre-market level. It'll just show you yesterday's level. So if you ever see that one showing up in the watch list, you got to go to the chart and look at what's really happening on that one. And then nat gas, I mean, this thing's been a joke and nothing has changed there. If you're trying to trade nat gas, use the spot, right? It doesn't hurt anything. Um, oh, it's over here. So there's a spot. You go to commodities, XNG USD. That way you got a better feel for what's going on in the nat gas space. There was a post about Strategic Petroleum release late yesterday afternoon. It was the Energy Department contracts have been awarded for the acquisition of 3.25 million barrels of oil for the Strategic Petroleum Reserve. That came in yesterday afternoon around 2, I think. Kind of late in the day to be getting that data. It should have came in at like 10:30, but either way, still waiting to dig more out on that. But it kind of goes with that collar that we've talked about on crude. And if that is going to be gone, well, then we want to think about those higher levels. So we got US dollar Japan's 10-year bond breaking out this week. It's kind of been a big deal. Strong gap up, and it hasn't stopped. We were in this area where we had a lot of selling defending across that top, but it's kind of taken on the run. This ties in directly with the threat of US dollar Japan coming up and getting into that 151.5, 152 area. That's intervention levels, right? This is kind of ties right back in with them maybe changing everything. Or the threat that they don't, right? What if they don't change anything and we see us run back up into that high and start threatening that 152? All right, in the fangs, we've got a gap up, like a red to green. So we closed here. We already gapped up to 122. That's mildly bullish this morning. It's not enough by itself. But if we can see more out of them fangs this morning after we get on the other side of PPI, then we could get this nice continuation in the S&P and the NASDAQ, of course. We are closer to the upper level ADR than we are the lower level. All right, everybody, that's what I got. Watch the clock. Be careful. I'll see you all tomorrow.